that happened that are completely new. So, disclaimer, obviously, you know, every attempt has been made to be right, but if we're not, that's not our fault, and it's not specific to you, so please always get specific advice about your circumstance before you do anything. So what I'm going to talk about is just some general observations about the budget. Then I'm going to talk about the 100% depreciation claims. I'm going to go through an example of how it can work effectively, and then also the tips and tricks for when that happens. I'm going to go through loss carryback as well. I'm going to go through the personal tax changes that were announced in the budget, that Limito offset, and also the personal rates that are legislated to start in the future. I'm going to talk about superannuation measures as they apply to businesses and employers. Kurt's going to cover the other superannuation measures. Just some sort of general business measures that were included, and then something that's not from the federal budget but from Queensland allocations, the current grants that are available that businesses should look at. Okay, so general observations. It was a big spending budget. There was a lot of money spent, but not that much of it was on tax changes, as it usually is. So there was $17.7 billion for aged care after the Royal Commission. There was a couple of billion for mental health. There's nearly $2 billion on childcare subsidies. It's a huge loss. If you made a $161 billion loss in your business, you wouldn't be very happy. That's what the government's done this time. So, you know, it's all spending this time, but it's not going to continue forever. Most of the items related to businesses are sort of timing differences. They're not permanent structural changes. They're bringing forward some savings you can get now, but those things will catch up later. They're designed to encourage growth and to stimulate things now. And the tone of the budget also focused a lot on employment. Another thing that I thought was kind of interesting was just to understand where the revenue in the budget comes from. So it's mostly from individual income tax, company tax and GST. But the individual income tax is very, very high as a proportion of income compared to most other countries. So this is why there's often been that push to reduce personal income taxes, and we have those legislated cuts for the future. But whether they actually happen and whether that individual income tax share comes down, I guess we'll see over the coming years. Okay, so the 100% depreciation claims. Now, the changes from this budget extended the rules which came in the October budget, and those were scheduled to end in June 2022. But they now apply until June 2023. So you have 3 years in which you can do this. You don't have to do anything in the next 6 weeks by June 21. You don't even have to do it by the following June. It's now the June after that. So you've got 3 years in which this can apply. And what it is that you're going to get a 100% claim for eligible assets that you purchase and receive those ready for use before that 30 June. Now, which assets it will apply to depends on your turnover. Now, I didn't put that if you have more than a 5 billion turnover that it doesn't apply, but if you do, why are you listening to me? So if you've got between a $50 million and $5 billion turnover, it's only going to apply to a brand new asset that you purchase. If you're between 10 and 50 million, it will apply to brand new assets as well as second-hand assets. And if you've got a less than $10 million turnover, it will apply to all those things, as well as any asset you already hold that's being depreciated will be immediately claimed and reduce your taxable income. So there's going to be a lot of deductions for buying these new assets. What are some of the tricks associated with this? Well, some things don't count. So land and buildings don't count. So if you think, oh, this is great, I'll go buy a new warehouse and get an upfront deduction for my $1 million warehouse. No, the land and buildings don't count. It's got to be a depreciable asset, not land and buildings. It can't be something that you're claiming the R&D tax offset for. It can't be something that you're just going to effectively sell through a lease out arrangement. So if you buy it and then you just lease it out to people more than half the time, that's not going to be eligible. And there's some software that's excluded as well. Cars. If you buy a car, you're going to get a claim for $59,136 as the maximum. So it's fine to buy a more expensive car than that, but you're not going to get any more tax deduction than that for that car. Another trick, the sale price of the asset when you sell it is going to end up being taxable to you. So if I've purchased a car now, claimed my $59,000 deduction, there's no cost left, so then when I sell it, I'm going to make a gain for whatever I sell it for. I recommend checking with your accountant, check with us before you buy the asset thinking you're going to get 100% deduction. Don't take your advice from a car salesman. Don't take your advice from a real estate agent. Take it from your tax accountant. And the other trick, it needs to be installed ready for use to make the claim, so it can't just be ordered, but it doesn't have to be paid for in full, so you can finance it. You know, you can have a chattel mortgage or a hire purchase and still get this claim without all the cash going out. So let's look at an example. I've got Harry, who's running a real estate agency, and the 2021 year is looking pretty good, pretty profitable. He's showing, he thinks, about a $350,000 profit for the year. So he decides he's going to upgrade his vehicle fleet. He's going to purchase his sales agents and property managers 8 new vehicles. They all cost 40 grand. So he's going to spend $320,000 on this capital expenditure. He's going to finance them over 3 years. So the monthly payment's $1,150 per vehicle. And he gets the vehicles and they start being used on the 20th of June this year, so in 4 weeks' time. Now, let's do a tax calculation on this. How's this going to work? So if he didn't get his 100% claim, he would have had all his income less his wages and other expenses. That's his $350,000 profit that he thinks he's going to make. He'd have $2,000 of depreciation because he's only going to get 10 days of depreciation. So almost no depreciation claim. Brings the $350,000 down to $348,000. The tax on that $348,000 is about $90,000. With the full claim, his $350,000 is reduced by that $320,000 full depreciation of the assets. Taxable income is only $30,000, so the tax is only $7,800. So he's got a tax saving of $82,000. Now this is all the pictures that I put is usually the faces I imagine people are making when I tell them what their tax result is for the year, so just keep that in mind. He's happy with that. And when we look at the cash flow calculation, so not just the tax result, it's a very similar result. So without the 100% claim, we're going from our $350,000 starting position of profit, but we've only made $9,200 of payments because we've only had to make 1 month of purchase payments, and then we've had to pay our $90,000 tax. So we've got $250,000 of tax left at the end of the year after our tax and finance payments. But with our 100% claim, we're going from $350,000. We've only paid $9,000 in finance payments. We've paid almost no tax of only that $7,000. So we've still got of our $350,000, $333,000. So it's a really, really good result. You know, it's $80,000 better than if this 100% claim didn't apply. Yeah. But like I was saying earlier, this is only a timing difference. What's going to happen in year 2? Without our 100% claim, we're going to make our $350,000. He makes a $350,000 profit every year. It's an unbelievable business. It's so consistent. You just would never believe this would happen. But for the example, it does. So $350,000, he's going to get depreciation because he hasn't claimed it all yet. So his taxable profit's going to be $270. The tax is going to be $67 for this year. But with our 100% claim, we're starting at $350,000 and there's nothing left to claim. We already claimed it all. So we're going to have a taxable profit of $350,000. Our tax is $87,000. So our tax is going to be 20 grand higher than it would have been if we didn't get the full claim in year 1. So he's sort of going, why is my tax higher than I thought it would be? I've made the same amount of money. This doesn't really make sense. And from a cash flow perspective, with no claim, he's got his $350,000 profit, he's made his finance payments through the year, paid that lower amount of tax after having the depreciation, and we're left with $171,000 of cash of the $350,000. But with our 100% claim that we've claimed, we've got our $350,000, but then we have to still pay the finance payments. We've got to pay all that extra tax of $87,000. We've only got $150,000 left. So we've got less cash as well. And what's going to happen in the third year? Okay, at the end of the third year, Harry needs to move back to the UK after a family disaster. So he leaves his wife behind. She's going to wind things up. They sell the cars for 20 grand each, but the trading otherwise is consistent at that $350,000 profit level. So what happens with our tax? If we'd had no claim, we start with our $350,000 profit. We get our depreciation claim of about $60,000 for the year. Then, when we compare our sale price to what our depreciated value is, we've made a small loss. So we hadn't quite claimed enough depreciation compared to what we sold them for, so we get an extra tax deduction of about $19,000. That brings our taxable profit to $271,000. And the tax is then $67,000. Now, if we've had the 100% claim, we've got nothing to reduce the $350,000 in terms of depreciation, and we've made a $160,000 profit on the sale of those vehicles, because they've been written down to nothing, so all of that $160,000 coming in is taxable profit. That means we've got $510,000 of taxable income, and we're going to pay $127,000 of tax. So, 60 grand more than we would have paid if we hadn't claimed up front. So this is the timing difference coming home to roost, that we got all our saving up front, but it doesn't apply, that every other year is still the same. And the cash flow is a similar result, that our profit of $350,000 is reduced by our finance payments. We get the cash in from selling the cars, we pay our reduced tax, and we have $330,000 left at the end of the year. But if we've had our claim, which we're going to get, we've got $350,000, we've paid our finance payments, got the cash in from the sale of the cars, paid the large extra tax, and we've only got $270,000 left over at the end. So what I'm saying is, don't get too excited with it from a permanent point of view. Like, it seems like there's some budget spending, and there is now. Go ahead and buy 8 cars and you won't pay much tax this year, but you will pay more tax in future because you've claimed it now. Loss carry back. This is something, again, which applies to companies with turnover less than $5 billion. And it will apply where you make a tax loss in either 2020, 21, 22, or 23. So you have to make a loss in one of those years, and you have to have had a profit in an earlier year than that. So either 2019, 2021, or 22. And what you do, if you make that loss in the later year, you claim back the tax you paid in the earlier year. If this measure didn't apply, you'd have to wait until you made profits in the future and then use the loss then. So this budget from last week gave you an extra year of it, of being able to carry back losses that you make in 2023. Previously, it was supposed to end in 2022. There are some restrictions, like you can't claim back more than the balance of your franking account, and there's some other exemptions as well. So again, just make sure you get advice from your accountant rather than the car salesperson before you create this loss and try to carry tax back that you might not have actually paid. Now I'm going to give an example of this one. So Megs is running a travel agency business, and in the 2019 year made a profit of $200,000 and paid tax then of $55,000. In the 2020 year, due to COVID, travel agencies are not doing so well. So they've made a loss $50,000. In the 2021 year, again, a loss of $100,000. 2022, Australia still doesn't fully open up. Another loss, $50,000. So we've made $200,000 of losses over those 3 years. So what this measure will allow her to do is claim back that $200,000 of losses against the $200,000 profit that was made in the 2019 year. And you do this in your tax return. So there's new labels coming into the 2021 tax returns to allow you to claim these losses. So I'll do an example of what happened. 2019 had a $200,000 profit, tax at 27.5%, you pay $55,000 in tax. 2020, we had our $50,000 loss. So we're going to use $50,000 of that loss against that profit that we'd made in the past and get our tax refunded that we'd paid on that $50,000. So we say, what was the tax rate in the year of the loss, which was 27.5, times our 50,000, we're going to get 13,750 of this 55 refunded from the 2020 year. 2021, we've made a $100,000 loss. So we're going to claim 100 back against this 200 profit. And our tax rate in this year is 26%, so we get $26,000 of that tax paid back. 2022, tax rate goes down again, so we only get to claim 25% of our $50,000 loss in that year back, so we get $12,500 back when we do this return. So we don't actually get all of the $55,000 back because of the decreasing tax rate. So another thing that's sort of a tip or trick with this one is you get to choose whether you want to do this. You don't have to do it, it doesn't automatically apply. But why would you not want to do it? Well, one reason is if you want to maybe pay dividends, because you want to have the franking credits available to pay those dividends. So sometimes you might want to do that. And you can't do that if you've used up the credits by claiming them back. Or there might be some sort of changing rate reason that you don't want to do it. So you might have in this year a 26 rate, but in this year you think you're going to have a 30% rate and you're going to be able to claim more back in this year than this year. So again, it's going to need someone who's really thinking about it properly to work out which is the best year to claim it in. But definitely, I think most of the time you'd want to be claiming that loss back. She's pretty happy anyway that she's got 52 of the 55 she'd paid back. Now, this 100% depreciation claim can interact really well with the loss carryback measure. It can really get some amazing tax and cash flow results in the year that you purchase the assets. So I'll give an example. Mark is running a construction company and he builds residential towers. He had a taxable profit in the 2020 year of $1 million. He paid $275,000 of tax. 2021 was just break even, but demand is really picking up in 2022. His 2022 profit he projects is going to be about $500,000. So he's considering buying the business the following equipment, which he currently has to hire for all his projects. So he's going to buy a couple of cranes, they're $500,000 and $300,000, a forklift, a truck, and an excavator that all cost $100,000, and another excavator, $150,000. So total equipment he's looking at buying $1.25 million worth of equipment. Expensive equipment, he's really going for growth here. He sees a big opportunity. If he gets this, he's going to be able to build twice as much, make twice as much money. He doesn't have the cash, though, to pay for them all up front. He doesn't have $1.25 million, so he's going to finance them with monthly payments over 4 years. So his monthly payment's going to be $27,400. So he gets them all and starts using them on June 20 next year. So he heard about this today, went, I don't have to panic and do this all this year, I'm going to make a proper plan and do this next year, and he had 12 months to plan this. How is this going to work? So let's look at his tax calculation. If he didn't do the claim or loss carryback, the 100% depreciation claim or loss carryback, his profit he thought was going to be about 500,000. The depreciation would only be 10 days worth, so almost nothing. So his taxable income's 496,000. So his tax is 124. There's no losses, so nothing else applies, so he's just going to pay 124 of tax. But he is going to do the 100% claim and loss carryback. So he's going to get a full claim for that $1.25 million depreciation. It's going to make a tax loss of $750,000. So he's going to pay no tax for this year. He's going to apply this $750,000 loss against the $1 million profit that he made from the 2020 year, which is going to give him a refund of $187,500. So no tax for this year, plus a refund of past tax of $187,000, total refund, 187. So the difference between paying $124,000 and a refund of $187,000 is $311,000. Yeah? He's very, very happy. And from a cash flow perspective, having not had these rules, his income's $500,000, he's paid his finance payment of $27,400, then paid the tax of $124,000, so he's still got cash of $350,000 approximately. But with the claim and loss carryback, his $500,000 has only been reduced by $27,000 of finance payments. He's got income of past tax paid of $187,000, so he's got cash generated of $660,000. So he only made $500,000 profit, but he's now got $660,000 cash. So he's actually making cash from buying this $1.25 million of equipment. He's very, very happy about this. Now, he's very, very happy now, right? This is year 1. But we know what happens in year 2 and 3. So I'm not going through the whole example again of year 2 and 3. That will take too long. But we can easily do that calculation. And if he doesn't remember those traps, he's going to get into a real bother if he doesn't save some of that cash to pay for those taxes in the later years, or if his trading doesn't work out and he doesn't achieve that growth and doesn't have that profit from making these investments in these assets. So it does provide an incredible opportunity for growth. Like, the cash flow is super generous in year 1. What's he going to use it for? He might use it to fund extra staff. He might buy extra stock. He might buy materials. He might have a growth in debtors. This is really an amazing way to potentially fund growth without having to borrow. Well, you're borrowing from the ATO. You're going to pay it back in those later years. But you do have to realise that cash flow will become negative in the following years, and it's not going to make sense to your trading results as to why you don't have the cash because your tax is so high. You're not going to go off the vibe of how my trading is going as to how much tax you're going to pay. You're going to have that catch-up of the timing difference. So if you're going to do a strategy like this, you absolutely must do full cash flow projections to make sure that you know what's going to happen and that you don't get into a big problem and end up looking like this. Personal tax rates and the offsets. So last year there was an offset announced called low and middle income tax offset. I've been saying LAMIDO, but apparently some people call it the Lamington tax offset. And what it is if your income's between $48,000 and $90,000, you get a $1,080 tax offset. So this was supposed to apply for 1 year, 2021. It's going to apply for 2 years now. It's going to apply for the 2022 year as well. You don't adjust the tax tables. So you're not getting it each week in extra pay. It's just going to be accounted for in the tax return, so people should get an extra refund of about $1,000. So that's really a stimulus effect that's being gone for, because people on this level of income are expected to sort of spend their extra $1,000 through the economy. That's really what this measure is trying to do. If you have a less than $48,000 income, you still get some offset. And if you have more than $90,000 income but less than 126, you still get some offset as well. But once you're over 126, there's no offset for you. The thing with this offset is that it's expensive. It's $7 billion. It never comes back. There's no timing difference with this like the other measures, like all that money is gone and is never coming back. And that's going to put a lot of pressure onto the other tax cuts that have already been legislated but aren't due to start until 2025, which really benefit people on much higher incomes. So these measures are designed to bring that individual income tax share that I showed you from the pie graph at the start down and have a smaller, tax collect percentage from individuals to be internationally competitive. They've been legislated, but with this other spending, that huge deficit, I think that these are now looking like there's a pretty good chance they could get reversed. I mean, I think Labor said today that they are not going to proceed with them in this form if they win the next election. So the change that's supposed to happen is nothing at the low scale, nothing at the below $45,000 rate, but at the moment, if your income's between $45,000 and $120,000, the rate's 32.5, and then from $120,000 to $180,000, it's 37. So what's supposed to happen in 2025 is that between 45 and 200, the rate goes down from these to 30%. So you get a threshold increase from 180 to 200 and a rate decrease at the same time. So really good for people who are on those incomes over 45,000, but particularly great for people who are on over 120 and over 200. So yeah, I just wanted to draw this to everyone's attention that even though they are legislated at the moment, if you're planning this far out, they may just never happen in this form. Superannuation measures as they apply to employers, I've got two things that I wanted to bring up. One is stapling of accounts. So accounts at the moment, employees can just have superannuation all over the place and nobody tracks it down for them. Really, it's up to them to manage and have a single account if that's what they want. And so when you have a new employee start, you give them a choice form. And they make a choice to either pay to their chosen fund, and then you pay it to that fund, or if they don't do anything, you pay it to your default fund. From 1 July, you need to still give them that choice form and pay it to their chosen fund if they choose one. But if they don't choose one, you need to look them up, find their existing super account and pay it to that account if they have one. So how are you supposed to do this? Well, it's supposed to be administered by the ATO. So it will be contacting the ATO in some way. Doesn't exist yet. Doesn't seem like they've allocated any resources to make the system. So who knows how it's going to happen, but it's supposed to apply in 6 weeks' time. Now, the other thing that I thought I'd mention is that there's going to be, from 1 July 2022, the removal of the minimum earning by employees before they get a super payment. So at the moment, if they earn less than $450 in a month, they don't get any super paid for them. That's going to go as well, and no matter what earnings they have, you need to pay super for them. So really, if you have a lot of casual employees who maybe only do 1 or 2 shifts and then they move on because they just weren't any good, this could be a real pain. To have to find their fund and pay it when they've done 1 shift for $100, and then you have to find their fund to pay them their $10 of super. But that's what's going to happen. Some other general business measures that I thought were interesting. There's going to be a new tax that applies to medical and biotech patents. So this is really to encourage people developing intellectual property in Australia and retaining that IP in Australia. So you're going to get a rate of 17% tax instead of either 30% or 25%. The patent has to be applied for after the budget date this year. And yeah, this is totally new to Australia, so it's light on detail as to exactly how it will apply. It just says they'll consult about it. But this kind of regime exists in a lot of other countries already. There's some changes as well with employee share schemes. So at the moment, the way an employee share scheme usually works is that an employer will say, I can't really offer you a lot of wages, but I can offer you some shares in our business, and they allocate you those shares or options to buy those shares. Now, if those things have some value, the employee is usually taxed on them unless they fit within the employee share scheme rules. But those rules are really difficult and can still result in you getting taxed on it even though you haven't received any money and can't sell the shares, and it's quite difficult situation that those employees end up in. So the new measures are supposed to alleviate that in some way, but the whole regime is still quite complex and I don't think will apply very much more broadly. Business measures, this was a good one. Time to start a brewery or distillery. The brewing and distilling markets are being promoted and focused on. I think they think there's about 600 brewers, 400 distillers at the moment. And they're going to be really focused on as a growth industry and something that could employ a lot of people. And they can get an up to $250,000 extra refund of excise that they need to pay on their sales at the moment, and that's from 1 July. So at the moment you can only get $100,000 of excise you've paid in total refunded, but from 1 July you can get up to $350,000. That's the same as wine, so these industries are being treated the same as wine, so hopefully will become bigger and sort of more internationally exported and competitive as well. Last one I think is on ATO debt recovery process. So currently if you have a dispute with the ATO and they issue an assessment and say, you know, you owe us $300,000 of tax, and you say, no I don't, I'm going to challenge this, and your option is to challenge either in a tribunal or in the court. Tribunal is much cheaper, supposed to be faster, and you know it has a range of other different decisions that can be made. But you do that and the ATO still wants their $300,000 paid, and their enforcement officers still trying to collect that debt. And there's no way to stop it without going to court, which is really expensive, and you know the whole process is supposed to be that you don't have to go to court. So the new rules are going to make it possible that the AAT can pause that ATO debt recovery until the AAT has decided your case as to whether you do owe that tax or not. So that's going to be a really good measure if you have any disputes with the ATO. Last thing on a few different grants. Business grants, these are all in Queensland. First one, Business Growth Fund Program, up to $50,000. Apply now. Okay, this is only going to be available until the funding is all exhausted. So get your application in tomorrow if you think it's going to apply to you. It's going to fund specialised equipment to unlock growth potential and expand your workforce. It'll fund up to 75% of the cost of that equipment. So you do have to fund a little bit yourself, but still 50 grand is a pretty good free money. To be eligible, you have to have more than $500,000 turnover and a plan to grow 20% in 12 months, which is either in turnover, profitability or employment numbers, and there also has to be some link to an increase in employment. So I really recommend, if you think that you could have rapid growth and you meet these things, to look at whether you might get your 50 grand of free money. Business Basics Grant will give you $5,000. Application start 31 May. 11 days time. Start writing your application if you want $5,000 free money of the government to provide you training and coaching in business, professional business advice of a business plan, business or continuity plans, website building or strategic marketing. Now it sounds really good, and then you look at the eligibility. You have to have a turnover less than $300,000. So that's going to knock out, you know, more established businesses or larger businesses. But if you're a really small business and you're just starting, you know, it's going to be, I think, fairly simple to get this $5,000 grant. So I would really encourage you to contact your accountant, help them get you this grant. This could be a great one. Last grant, Small Business Business Boost Grant, will be up to $15,000 starting in July. So not too much detail out yet, except that it's going to come soon. And it's supposed to improve efficiency and productivity through automated software and CRM systems. There's no eligibility criteria released yet, but we'll definitely be looking out for that one to see, you know, which businesses could be helped out by 15 grand of free money from the government. Okay, so that is the end of my session on the update. The next session that we'll have is going to be Kurt Granger from HKS Financial Planning. We'll just take sort of 25 seconds to reset the slides and then Kurt will be up.
Okay, good evening everybody. Thanks to Tom, that was a really insightful presentation. My name's Kurt Granger. I am a Director of HKS Financial Planning and also one of the senior financial planners that we have within our business. Hopefully most of you are familiar with our business, but if not, we work really closely with the guys at Hoffman Kelly and have done for well over 10 years now. Today I'm going to be presenting on the federal budget update that was announced a couple of weeks ago. So what we're going to be looking at is some of the changes that are coming into effect as of July 1st this year, and then some of the proposed changes, particularly around superannuation changes that are proposed to come into effect through the new budget, and then we'll focus on the first home buyer scheme. But before we kick off, as Tom said, during his presentation, all of the information that's provided within this presentation is hopefully correct at the time of the presentation, but of course we are not providing any personal advice. If you do want personal advice, certainly seek one of us out. We're more than happy to help. Important reminders, particularly with the budget measurements. At this very point in time, a lot of these announcements are only announcements. The successful implementation of these measures really comes down to whether or not they get passed by Parliament, and with the way that the Senate's sitting at the moment, that's certainly not a given. And the final version of these measures may differ from the announcements that I go through. So what we're going to be talking about today, as I said before, is the indexation changes, which was part of the budget announcements back in 2017. The proposed superannuation changes that tie in to those 2017 changes and reform that will come through from July 1, 2022, and then we'll touch quickly on the first home buyer super scheme, which I think is going to provide a big leg up to anyone that has not yet purchased a home and may suit some watching at home in the room or some children of those as well. So we'll kick off. So the July 1, 2021 indexation period, so what we had back in 2017 was some reform that the government introduced and then passed through Parliament as part of the Simpler Super reform, and the idea behind this was to make superannuation more attractive to people, and then we have some indexation of some measurements that they brought in that are now coming into effect from July 1 this year. In particular, what we're going to have is more generous contribution caps that will allow anyone that's able to put more money into superannuation next year than what they previously have been able to over the last few years. We'll be focusing on today the non-concessional contributions in particular because they are the most generous, but I'll also touch on the concessional contributions. So very, very simply, what we have at the moment here is a concessional contribution cap in the year 2020 and 21 and previous of $25,000. So your concessional contributions, for those that aren't aware, are those that your employer puts into your account for you. your salary sacrifice contributions, and also those contributions for which you put in personally in which to claim a tax deduction on. So at the moment we have a $25,000 cap. That is going to be increasing to $27,500. So as of next year, you'll be able to add a total of $27,500 to super over any of those methods and claim it as a tax deduction. At the moment, you have the ability to also add to superannuation via what's called a non-concessional contribution. Now, very simply, a non-concessional contribution is a contribution for which you do not intend to claim a tax deduction for. It's a contribution from monies from which you have previously paid tax on. At the moment, the current limit for that is $100,000 per annum, and that's increasing to $110,000 from July 1. In addition to the standard non-concessional contribution limit per annum, we have what's called a 3-year bring forward rule, okay, which allows you to bring forward 2 years worth of contributions and add a total of $300,000 in any one point in time. That prohibits you then from making contributions for the next 2 years and then opens up the cap space there beyond. This is also increasing in line with the non-concessional contribution to $330,000. The only contribution limit that's not indexed this year is the downsizer contribution, which applies to those over the age of 65 and sell their home, which remains at $300,000. So that all sounds fairly simple until you start to break down the detail. Pretty busy slide. So this is really the predicament that we find ourselves in at the moment. We have rules that were introduced in 2017, measurements that were introduced in 2017 that were supposed to index are now indexing. We have age limits that are prehistoric that are indexing, that have indexed, but haven't indexed to all contributions. Okay, so when it comes to contributions, if you're under the age of 65, you are fine. You can contribute so long as you meet your total super balance limit. You can make a non-concessional contribution, you can make a bring forward contribution, you can use any one of your caps, no problems at all. If you are 65 to 66, you need to give consideration to how you're going to contribute. You can make a non-concessional contribution at the $100,000 limit per annum, but you cannot take advantage of the non-concessional bring forward rule. You can make a concessional contribution in line with the cap. If you are 67 and over currently, you need to meet the work test in order to be able to contribute to superannuation at all. So you cannot contribute to superannuation if you are 67 or over unless you meet the work test. The work test suggests that in any financial year, you need to have worked for a period of 40 hours in 30 days to open up that eligibility. And once you do open that eligibility, you are limited to the annual increase, the annual amounts only. So you cannot use the bring forward provision. The downsizer contribution applies to those only age over 65. Okay, so getting back to the non-concessional contributions, so provided you're under the age of 65 or 65 to 66, you can make a non-concessional contribution. However, this is also governed by your total superannuation balance, which was also introduced in 2017. What's the total super balance? Okay, so the total super balance suggests that at the moment, if you have an amount measured at June 30 of the previous financial year of less than $1.6 million, you're able to contribute to superannuation as a non-concessional contribution, provided you're of the right age. Your total super balance is the sum total of all of your superannuation interests, including your accumulation phase interest, so that is the contributions that your employer makes to your Q Super account or your Sun Super account or your Asgard account. Any retirement phase interest that you may have, so that is transition to retirement pensions, allocated pensions, account-based pensions, defined benefit accounts, rollovers in transit, so where you are transferring from one account to another and they are not identified anywhere, and certain limited recourse borrowing arrangements via a self-managed super fund. You simply add all those up as at June 30 of the previous year and you get a number. If that number is under $1.6 million currently and you're of the right age, you're able to contribute to superannuation. If you are over that number, you're ineligible. Despite your age, you cannot make non-concessional contributions. This measure here, introduced in 2017, is indexed to CPI each and every year, but goes up in $100,000 increments. And as such, we're now seeing the first rise since 2017 up to $1.7 million. So what we may see is a person that was ineligible last year become eligible this year to add a non-concessional contribution. So very importantly, if you are thinking about making contributions to superannuation, you need to A, identify if you're in the right age bracket, and then B, identify whether or not you have the ability within the total superannuation balance to do so. Where we see this mostly come into effect is when we're looking at the bring forward rule. Okay, so the bring forward rule is via non-concessional contributions, which is governed by the total super balance, the $1.6 million cap there. The $1.4 million rule is one that limits total non-concessional contributions and bring forwards, and I'll go through that in the next slides. The total super balance also governs the carry forward concessional contributions and also the work test exemption. I won't touch on those today given the timeframes, but if you do want more information with regards to those two, certainly make an appointment to come and see us. The bring forward rule. So as I mentioned before, the bring forward rule is designed to allow people that have realised an asset or have a large sum of money from an inheritance that want to add money to their superannuation in one lump sum. The rule allows you to make your annual non-concessional contribution plus bring forward 2 years of contributions. Now, very importantly, as this is the limits moving out from 100 to 110,000, you need to consider and be wary of the rule will apply to the year in which you make the contribution. That is, if you make the contribution this year, you'll be governed by the $300,000 limit. If you make the contribution next year, you'll be governed by the $330,000 limit. This rule is triggered by adding $1 more than the current limit in any one financial year. So if you add $100,001 this year, you will trigger the bring forward rule and you'll be capped for the next 2 years to a maximum of $300,000. So some thought needs to go around how you're going to add these lump sums in, and then whether or not you do it this year or next year to try and really take advantage of the maximum amount that you can get in. Now, this is currently before Parliament. There was a bill put forward last year to have the bring forward age pushed out to 67 to align with the other contribution ages. But due to the COVID impact, this was the only rule that didn't get passed. June 20 this year, when Parliament meets again, it's proposed that this will be brought before Parliament, and we are hopeful and very confident that that will change, and this limit will be pushed out to 67 to align with the other ages, and you will therefore be able to make non-concessional bring forward contributions right through until the age of 67. So let's have a look at how this works. So we have JT. JT is a young looking 58, has a total super balance of 1.1 million and receives an inheritance of $450,000. Now, JT makes the mistake of not going to see his financial advisor to seek out advice on how to maximise his contributions. Instead, he speaks to his mate at the barbecue, and his mate suggests to him that he can put in $300,000 this year, and that's exactly what he does. JT now is limited. He cannot make any further non-concessional contributions because he's utilised the entire bring forward cap until the year 2023-24. Under Strategy 2, JT goes to seek some financial advice. His financial planner suggests to him that he can add $100,000 in this current financial year, therefore not triggering the bring forward rule, and then he contributes a further $330,000 in 2021-22 via the bring forward rule, gives him a total of $430,000 in total super contributions, and he can no longer add any non-concessional contributions until 2024-25. One thing to be wary of with the non-concessional cap is that it is limited if you have a higher super balance close to the cap. So very simply, if you have less than $1.4 million, you can take full advantage of the bring forward rule. So you can add 3 years worth of contributions. That's indexed up to 1.48 as of July 1. So obviously, if you have less than 1.4 now, given that July 1 is 6 weeks away, you'll be very likely be able to add 330 from July 1 onwards. If you have between 1.4 and 1.499 in super at the moment, you can add 2 years worth of contributions. Moving forward, this goes out to 1.48 to 1.59 to also be able to add $220,000 worth of contributions. If you have more than 1.5 million and less than 1.6, the current total super balance cap, you can add 1 year's worth of contributions. Going forward, that index is up to 1.59, up to 1.7 as a total for you to be able to add in the full 1 year's contribution. Okay, so there's a lot of thought that needs to go around this sort of planning, a lot of thought around the age, the total super balance, and whether or not you should be adding this year, next year to try and really take advantage of those generous caps. Sounds easy? Okay, so that's getting money into superannuation. In addition to that, the government decided that it would be very, very smart to bring in some complexity around taking money out of superannuation. So they introduced a cap called the General Transfer Balance Cap. Now this General Transfer Balance Cap is designed to govern the amount that you can transfer to the pension phase of superannuation. So judging by the room, I would suggest that most of us are within the accumulation phase of superannuation. That is where we are adding money to superannuation in preparation for our eventual retirement. When you do retire, you generally transfer most of that money to the pension phase of superannuation, and that is governed, the amount of money that you can transfer is governed by this cap. This cap here was introduced also in 2017 and is again indexed to inflation, but only goes up in $100,000 increments. So once again, this is the first time we've seen this cap move out. Why did they introduce this measure? Very simply because every single dollar that you put within this amount in the pension phase superannuation does not attract any tax. It is a very, very tax effective investment, and so the government doesn't want people to be adding 5s and 10s and 15 millions of dollars worth of tax-free amounts into these areas. When you trigger the transfer balance cap, you get allocated, excuse the terminology, but you get allocated a personal transfer balance cap. That becomes your own cap from that point in time. So you trigger a transfer balance cap, personal transfer balance cap, in the first year that you commence an income stream. Now this is where it starts to get a little bit tricky. If you have utilised your entire personal transfer balance cap, that is, you have transferred into the pension phase of superannuation $1.6 million prior to July 1st, 2021, you needn't worry. Your cap is $1.6 million and will remain that way forever, and there's nothing you can do about it. If you have not used any of your personal transfer balance cap prior to July 1st, 2021, your cap will be $1.7 million until it's indexed again. The tricky part is if you've commenced an income stream, so you've used part of the cap, but not all of it, you're subject to what's called a proportional cap between $1.6 and $1.7 million. Now, I am a bit of a mathematician. I do love numbers, but it doesn't take a genius to work out there are 100 different variations that you can have within this. So this is going to be a logistical nightmare for the ATO to administer. I'll show you how the calculation works. Oh, here we have Mr. Bean, a little bit worried. Okay, proportional indexation of personal transfer balance cap. So this is only going to affect a limited amount of people, but we'll run through the calculation so that everyone's aware of how it works. Very simply, if you have an amount that you've transferred that is less than the general transfer balance cap, you'll be able to index the remaining portion of that cap. That's what it's designed for. How do we do that? First of all, we determine the maximum amount of the personal transfer balance cap that has been used and the date. So the maximum amount is if you've transferred two amounts to the pension phase, $800,000 and then $500,000, your maximum amount is $1.3 million. You have $300,000 left over. That $300,000 can be indexed. You calculate the value above, so the maximum amount, as a percentage of the personal transfer balance cap on the date that it was identified. You then calculate the unused cap by taking that percentage away from 100 and then round that number down. I mean, how easy is that? We should be able to all do that, right? It's just, you should be able to just do that in your head straight away. Let's have a look. Here we go. Cameron. So Cameron commences an account-based pension with $905,000 in August 2018. This is his only transfer balance credit. Therefore, the highest amount is $905,000, which becomes his personal transfer balance cap. And the corresponding date of that for the general transfer balance cap is $1.6 million. So what we do is we divide 905 by 1.6, gives us 56.56%. So Cameron has used 56.56% of his personal transfer balance cap. The general cap is increased by $100,000, okay, for the 21-22 year. It's going from 1.6 to 1.7. You round Cameron's cap percentage down, so it was 56.56, you round it down to the nearest whole percent, so that becomes 56%. You then take that amount away from 100, which gives you 44%. So he has 44% that's able to be indexed, 44% of $100,000 is $44,000. Add that to his original cap amount, 1.644. Cameron has used 905. 1.644 take away 905 gives Cameron now the ability to add a further $739,000. Now, how they are going to measure this and quantify this, I have no idea, but when you come to speak to someone about this, it's really important that we get these details together. Any excess cap amount attracts excess tax. So it's important that you know exactly where your cap sits at any one point in time. Example 2, Cameron, same situation, except in this instance, Cameron decides to be smart, thinks he's going to be smart. He transfers $100,000 back thinking that that will reduce his cap space, but in actual fact it doesn't. It's always the highest amount. If you've used 905,000 previously, that is your highest watermark. That's what it will remain, and the calculation remains exactly the same. Other things that are indexing come July 1st. So the government co-contribution and the spouse contribution are both linked to the personal super total super balance of $1.6 million. That's going out to 1.7. If you have a balance of less than 1.7, you are eligible for the government co-contribution and spouse contribution. Interestingly though, the spouse contribution tax offset is limited to those under between $37,000 and $40,000 worth of income, is not indexed, so that will remain the same. The co-contribution threshold, that is where the government will give you a superannuation boost if you're a low income earner. You get the full boost from $39,000 currently, that's indexed up to $41,000. You get a partial boost right up to $56,000 under the new indexation. Eligibility to use the carry forward concessional contributions, that's contributions that you wish to claim a tax deduction for since 2018 for which you didn't, is $500,000. So if you have less than $500,000, you can effectively use your unused concessional contributions. Division 293, some in the room and watching at home will probably be familiar with Division 293. That's additional 15% contributions tax on earnings, on contributions for anyone that earns $250,000 above. Now, interestingly, that's also not being indexed. July 1st also sees the superannuation guarantee increase to 10%, okay, up from 9.5. Your preservation age, the age in which you can access your superannuation, is now 59, and the age pension age will increase to 66 years and 6 months. So that covers all of the changes that are coming into effect on July 1. We'll now go through the proposed changes as part of the most recent budget. So some of the key announcements. We saw before on that earlier slide, which was quite convoluted, the impact that the work test and in particular the age requirements has on your ability to add money to superannuation. And it can be quite difficult at times to work out whether you're eligible or not. So the government is setting a course to try and rectify that by abolishing the work test. Downsize of contributions. This is going to become very, very popular. A measurement that is already very popular. The downsize of contribution is going to decrease to the age of 60. And then as Tom touched on before, super guarantee, removal of that minimum $450 test. Okay, so amendment of the work test. So the work test is applicable for anyone at the moment that wishes to make contributions to superannuation above the age of 67. The proposal that's due to come in on July 1, 2022 is that clients under the age of 75 will no longer have to meet the work test. If you're under the age of 75, under the proposal, you'll be able to add money to superannuation. You'll be able to add non-concessional contributions, you'll be able to add concessional contributions from your employer and salary sacrifice. You will not be able to add tax deductible member contributions out of your own money, okay? So that's one thing to be wary of. What we're hopeful for and what we're really looking for is the ability for you to utilise the bring forward rule. And what this may open up is a lot of really strategic financial planning about using the bring forward rule, perhaps on multiple occasions over a 10-year period, if clients continue to retire sort of that 60 to 65 range. Once you're 75 and above, you're ineligible to contribute to super. That's not changing. Okay, so opportunities. Irrespective of the bring forward rule changing, what we'll have here is the ability to add another 8 years of non-concessional contributions. Okay, so that's potentially another $880,000 should you have the funds. If we get the bring forward rule passed, which we're hopeful for, you'll be able to access the bring forward rule and perhaps on multiple occasions, as I said before. Access and recontribution strategies. So this is where some strategic financial planning will really come to the fore, I believe. With unrestricted access from the age of 65, that date hasn't changed. There'll be opportunities to restructure your superannuation benefits for estate planning, so minimising estate tax minimisation, equalisation of superannuation benefits, and maximisation of transfer balance caps. And we'll have a look at a little example here. We've got Darren and Kylie, both aged 68 in 2022, 23 and retired. So Darren has been a high income earner all his life, and he's maxed out his transfer balance cap. So he currently has $1.6 million within a pension account and a further $1 million that he'd accumulated in superannuation that he wasn't able to transfer over to the pension account previously. So his $1.6 million sitting in an area that attracts zero tax. He has $1 million sitting in an area that attracts 15% tax on the earnings. Kylie, his wife, has $300,000 within an account-based pension account. So they're quite well off. What the new rules will potentially allow us to do is to draw out $110,000 per annum over a 7-year period from the date of 65 and contribute these funds into Kylie's account. And what we're able to do by doing that is transfer money from here in an area that's taxable into an area that's tax-free and really increase that tax-free portion by $770,000. Now there is all sorts of benefits to this, particularly around estate planning and earnings that have become tax-free. So I think there'll be lots of thought and lots of strategic work that comes into effect with these new caps opening up and the new age limits increasing up to age 75. Downsizer contributions. This has actually been quite popular already. At the moment, if you're over the age of 65 and you sell a principal place of residence that you've held for more than 10 years, you can add in $300,000 per person. So if you're a couple, up to $600,000 can go into your super, irrespective of your total super balance. So this is not governed by your non-concessional caps, it's not governed by your total super balance, it is a free swing for you to able to top up your super once off. No age limit. The proposal is to bring that down to the age of 60. So what are the opportunities? Going forward, with the generous non-concessional caps, an eligible couple in their early 60s could sell their home and contribute up to $1.26 million in any 1 year by each making a maximum downsizer contribution of $300,000 and a maximum non-concessional contribution of $330,000. You'll have the ability to add additional funds to super despite being in excess of the total super balance. So we will start to see this. Total super balances are being encroached upon all the time. Couples can now sell their home at the age of 60 despite having $1.7 million in super and add another $300,000 each. Some considerations. So downsized contributions are counted towards the total super balance at the end of the year in which they're added. Okay, so not until the end of that year are they added. So you want to make sure if you're doing a combination of downsizer and non-concessional contributions, you get them in the right order so that you don't eliminate yourself from being able to do that in the future. Contributions has to be made within 90 days of receiving the proceeds, and the main residence has to be owned for a period of 10 years or more. Finally, as Tom touched on before, we have the superannuation guarantee contributions. Now this doesn't apply to anyone that earns less than $450 per month. Really impacts those taking career breaks and working multiple casual jobs. And the proposal is that from July 1, 2022, super guarantee will be payable on all income, okay, which is fantastic for those that are looking to build their superannuation, but as Tom touched on before, not so much for employers that have people coming in on a day-to-day basis. And the last one I wanted to touch on, which I think this will become perhaps more popular than it is already due to the increase in size, is the First Home Super Saver Scheme. So the First Home Super Saver Scheme was first introduced in 2018 as a way to encourage those without a home to save for their first home in a tax-effective manner. And basically, what it allows you to do is you can add money to superannuation via concessional contributions, claim there's a tax deduction, and then take the money out at the end tax-free, okay? The current limit is $30,000. So you can add a maximum of $30,000 over 2 years because there's a $15,000 per annum limit, and then take that out and use that, so long as you use that to purchase your first home, you get that amount plus any earnings tax-free. The government, as of July 1, 2022, are going to increase this to $50,000. So if you're part of a couple and you wish to utilise this strategy to buy your first home, you will have access to $100,000 plus earnings to use towards your first home. So the opportunities here are for anyone that's on a tax rate of more than 15%, you'll actually get a tax deduction to add money to your fund to save for your first home. Higher limits apply. Higher limits allow tax deposits to grow more tax effectively. It is a little bit of buyer beware. There's a fair bit of administration that's required with this. You need to govern your own limit. There is no way at the moment where you can measure your limit. It's governed by you, and the limits aren't applied until you release, so you won't actually know. So you need to make sure that you remain within this $15,000 per annum limit. You need to submit your deduction notices. So there's a lot of onus upon the individual to make sure they're doing this correct. Before you sign a contract, you need to get a determination from the ATO to say that you're eligible. And then once you do that, you need to enter into a contract 14 days before or within 12 months after requesting the release. So there is a lot of admin, but certainly an area that I think that will become very popular from July 1, 2022. So in summary, the upcoming indexation measures allow for more generous contributions to superannuation, and that's fantastic. We do have this transition period now between now and July 1, 2022 when the proposed measures come in place, where there are different ages applying to different contributions, and we need to be wary of that. We have transfer balance caps that are moving out and total super balance caps that are moving out, but you could be stuck in the middle if you've used any of those before. The budget proposals that have been introduced recently as part of the most recent budget are not yet law. Okay, they need to pass through Parliament, and if and when they do pass through Parliament, they don't come into commencement until July 1, 2022. Thank you very much. I think we have 15 minutes now for questions.
10.
10. We've got 10 minutes now for questions, if I'm not mistaken.
Just if there are that many.
If there are any.
Yeah, so happy to take any questions that anyone has for either me or Kurt.
Any on the Facebook, Tom, or the email?
I know we had some emailed earlier today. Who's got those? Shelby? Yep.
One of the questions was to do with the 100% depreciation rate, with the car cost limit being $60,000. What happens if you purchase a car for $100,000?
Okay, so the question is, with the 100% depreciation claim, and how does it relate to the car limit of about $60,000 if you purchase an expensive car? So if you purchase a $100,000 car, what happens to the extra money? Nothing happens to it. You just don't get a tax deduction for it. So it's fine for your business to buy that car for $100,000. It's only going to get a tax deduction for $60,000. The other $40,000 just goes nowhere in the tax return. Yeah. Okay, so what's the process for applying for the business grant? So there were 3 grants that we talked about. The first one was the $50,000 for the equipment grant. That process is fairly involved. I would just go to the Queensland Government website and look that information up. But basically, you need to collate a whole lot of information and submit it. Then they will allocate you an appointment with they call it a mentor, who will discuss your suitability for this grant and probably whether you're going to get it or not, and then request further information from there. So I think, it's $50,000, it's a fair bit of money. They want to make sure that it's going to exactly who they want for the purposes they want. But if you think it is the right purpose, 50 grand is worth going through that process. So it's much more onerous than the Business Basics grant of the $5,000, which is opening in 2 weeks. It's all online. You submit basically a declaration that you are eligible. You submit the quotes from the suppliers who are going to provide you the services that you would like to cover. and then you wait until they assess and say, yes, we are approving you or not, and then if you are approved, they pay you the $5,000. The $15,000 grant that starts in July, there's no information about that yet. We won't know until it comes out in July.
Tom, with those grants, did you want to just, what's the time frame look like on it?
The timeframes for the grants as to between applying and being approved, or in how long do you have to apply? So how long do you have to apply? So they basically say that they will apply for a certain limited time frame or until the funding is exhausted. So last year when they had the COVID grants, they had the same criteria, and the number of applications exhausted the grants within like a couple of days of them becoming open. So I would be applying ASAP because it's unlikely that it's not going to be exhausted. Like, they're good grants, they cover a lot of really good purposes, so just apply as soon as you can for that one in July that's going to come out. Look it up straight away and then get your application ready before it opens and then submit it straight away. In terms of the time frame for assessing it, who knows? The first one that they had in Queensland last year took quite a long time for them to process it. I think they weren't expecting as much demand as what there was. The second one, they knew what was going to happen and they got approved really quickly. So I think probably now they'll be expecting reasonable demand and we'll have the staff to process those, but who knows? Who knows? I guess you just wait and see until they give you the money. It's sort of all at their control.
Tom, for the tax loss carryback, how do you go about claiming back a loss that you would have made in the 2020 financial year?
Oh, so how do you claim the tax loss carryback if you made the loss in the 2020 year? You claim this in the tax return, but you couldn't have claimed it in the 2020 tax return because the labels didn't exist. It didn't get announced till after the 2020 return started. So that's in the 2021 return. It's going to have two ways to claim, either for the 2020 loss or the 2021 loss in that return.
You had to have a profit in 2019 to claim the 2020 loss.
Yes, yep. So the earliest profit you could make to claim a loss against is 2019. So if you made a profit in 2018, you can't claim a loss from 2020 against that. It has to be from 2019 is the earliest profit you can use. But you could still make a profit this year and then make a loss in 2023 and claim that then. So, but yeah, 2019 is the earliest year you need to be looking at.
Tom, if I'm hiring casual staff and it's their first job, so say I hire a 15, 16-year-old out of high school and it's their first job, will I still be able to pay to my default fund for their contributions for the SGC?
So,
if they don't have another fund already?
So the question was, if you hire someone, it's their first job, so you try to look up their super account for the stapling purposes, you don't find anything, then what do you do? Yeah, then you pay to the default fund if you don't find anything. And I think probably that's what everyone will just keep doing for a while anyway, because there's no system to find it at the moment.
Is that being considered yet? Or is that
Yes.
July?
Yeah. That was in the October budget, so I'm sure that one has passed, that stapling. Any questions for Kurt? I have a question for you, Kurt.
Oh, good.
So the calculations are so complicated. How long do you think it will be before they scrap the whole thing and make it simpler?
That reform that was introduced in 2017 was supposed to make it simpler, and what's happened in effect really is that the indexation has caught people out, because once you've utilised all of your cap space effectively, or part of it, you can only index then part of your unused cap space. So look, how to make it simpler, it would be simpler just to have everyone at the same cap space, which we have been for the last 4 years. Everyone knows what that cap was, everyone knows what the total super balance and transfer balance caps are, and it was quite easy to apply. Yeah, going forward, I think, you know, to make things much simpler, and we've seen with the measures that are coming in to bring the age limits all into line, which they're all out of whack at the moment. They're bringing all those into line and then push those out to 75, abolish the work test. That is a much simpler understanding and easy to understand for everyone else to get money into superannuation. So I'd like to think that going forward we'll just have a cap, and whether you're over that cap or under the cap is the only measurement, but who knows. Superannuation is quite a big political tool, and it really depends on the government as far as which levers they pull to make it easier or more attractive or complex. Yeah, so the answer is I don't know, but hopefully soon.
Well, if there's no more questions, then we might finish there.
Thanks, John.
Good.
Well,
Thank you. Well done, mate.
Thank you very much to everyone who was